All right, this is Kerry Artak with the AgriTalk video supplement for the week of Monday, December 7th. Before I jump into the three markets I'm covering, which are, by the way, March corn, January soybeans, and January crude oil, I ask, if you haven't been already, and I'm guessing you have, but please tell your trader, hedger, friends, acquaintances about my service, if you would, artakadvisory.com. I've got the AgriTalk video link there. At the bottom of that, they could fill out a free trial form. 2 full weeks I give, no questions asked, no credit cards. You get an introductory call that could be a consultation if you like. And I do offer a 2-week trial every 6 months. So if you've had one before and you want one again, as long as it's not within the last 6 months, happy to do so. So let's jump into March corn. The first chart I'm going to show you is just a reminder of the big picture. And this is something I've been talking about since September when we had a buy signal above this long-term 15-year channel structure. That was essentially a failed longer-term sell signal that was elicited 6 months or so earlier in March when we closed below it for the first time after having tested it repeatedly for several years. There was no appreciable downside follow-through, and in fact, with the settlement in September back above it, indicated for me long-term resistance at 465 and a quarter. The only question was really not if, but when. How long would that take? At the time I was saying could be 2 to 3 months, could be summer of 2021. Tough call. Right now, we're a full 3-4 months into it, 3.5 months into it, and we may actually test it by the end of January or sooner. And I'll give you those parameters soon. But this is big picture here. Long-term support 360s, long-term resistance 460s, resistance expected over the coming weeks or months. Let's jump into the near-term outlook. Now this is the same weekly continuation chart, but blown up to look at just the last year or so of activity. You can see here we had the April low and we have the recent high in November. Now this is speed line analysis, trend defining speed line analysis. I use it along with channel formations primarily as my trend identifiers. And right now I have an ascending 1/3 speed line. They're constructed based on the extremes, this low from April against this most recent high in November, climbing weekly 398 and 3/4 this week. This speed line is trend defining. I'm not sure if we're going to test it or not. We just may. We do have a key reversal high here on the weekly chart, and that is usually a sign of impending near to possibly midterm, sometimes long-term weakness. But given the fact that we are in the midst of a longer-term buy signal that I showed you in the previous chart, and the fact that we've got decent support below the market in the upper 390s, tough call as to whether we're going to follow through all the way down into the upper 390s. But if we do, this speed line can absorb selling not only through the rest of the year, but really into later winter. And from here, I do think that 465 and a quarter channel top is likely between now and the end of January. Yes, between now and the end of January. And so I'll give you an upward pivot point here in just a moment. But while I have this chart, just a heads up that if we do actually close any week below this rising speed line, and it is rising on a week-by-week basis, 398 and 3/4 this week, the market has indicated a good high not only through the rest of the year, but more than likely into later winter, as I would then expect it to continue falling into the 350s or 360s. This 354 even ascending 2/3 speed line is considered a target based on speed line analysis if the market were to close below 398 and 3/4 at the end of any week. And this formation, this speed line, is rising in January. In very early February, you can see the 365 here. That is then by early February in sync with this long-term support at 367 and a quarter. And that area, by the way, in early February, late January, can absorb selling into spring, into summer of next year. And once tested, guess what? The 460s I'll begin talking about again as a possible longer-term objective. But right now, we do have bullish momentum still intact above 398 and 3/4, and I think there's reason to consider the 465 and change area as attainable by the end of January. And in fact, so here's the last chart I'm going to show you on corn. This is a daily chart. It's good for most of the week. It is changing ever so gradually. So what you see here is still valid on Friday, but it is changing into next week. This is in my daily corn newsletter analysis. 440 even is a ceiling, and I'll even throw this out there. Oh, I'm not going to throw that out there. I'll throw this out there. Here's your upward pivot point through the rest of the week, 428 and a quarter, and that is rising a bit into the 429 area later in the week. But if we close above this, the market rallies within 3 to 5 days to 440 even. 440 even is a formation that can contain buying through next week. From here, we could conceivably fall back into that 390s that I showed you in the previous chart. But given the fact that the market remains bullish into January, above 398 and 3/4, closing above 440 even is certainly in the cards, if you will, over the next couple of weeks. And if this week, if we close above 440 even, then we're only another 2 or 3 weeks away from testing this long-term resistance area at 465 and a quarter. This formation fully able to absorb buying into summer of next year, and is a significant upside continuation point well into next year. I'll tell you this, and this is the last thing I'll say about corn. If we were to close any week above this 465 and a quarter formation, I have a 650s objective that just might be realized by summer trade if this formation is violated in the coming weeks. Let's move on to soybeans. You may be familiar with this last week. This is big picture. In early November, we had a long-term buy signal that is still in effect above 1139 and a quarter. This channel top we tested again last week. It can absorb selling, as I say in the radio show and on my newsletters. It can absorb selling into spring, summer of next year, and above which I maintain a 3 to 5 month upside objective at 1377 even. That if tested, say in the spring of summer of this year, can absorb buying on an annual basis. I'll mention along the way I've got 1290 as well as a Fibonacci retracement level that can absorb monthly buying pressures when tested. But just to give you the bottom line here, holding above 1139 and a quarter, no good reason to be hedged. This market can actually push on into the 1377 even region over the next 3 to 5 months. On the other hand, let me continue with that concept because it's important. Upside. We do have, now this is just the March 21 contract. This is not a continuation chart. This is just the March contract. And I've been showing this is a daily formation I've been showing on the daily chart now for weeks. This is its average for this week, 1223.5. I don't know if we'll get up there. The daily chart is not as high, and it's a little bit more precise if you're looking for a buy signal into January trade. But the bottom line here, this is our next resistance. You can see we pushed through it a couple of times for a couple of weeks. We've never settled above this formation on a daily basis, and certainly not on a weekly basis. It's 1223.5. If we can get up and over 1223.5 over the next couple of weeks, and mind you, it's a moving target, then a price acceleration to the upside is expected, and I think we could see 1377 even level by March expiration, actually. Which would be, into later February, early March. So if we can close above 1223.5 at the end of this week, for instance, I see a 5 to 8 week rally playing out into the 1377 targeted long-term resistance area. Let's talk downside just to cover our bases here. If we close below 1139 and a quarter, there is one case to be made that such a failed long-term buy signal has seriously bearish consequences that could put the market all the way back to where this rally began in the 930s. But I'm uncomfortable doing so. I think that respect needs to be given to this ascending 1/3 speed line that this week is at 1070 and a quarter. So the way I'm framing this in my newsletters is bullish above 1139 and a quarter through winter trade, and I don't turn bearish through winter and into spring until or unless we close below 1070 and a quarter. If we close below 1139 and a quarter, 1070 and a quarter becomes a target, and we could trade inside this wedge for a number of weeks before the market tips its hand by closing either A, back above this channel formation, or B, below 1070 and a quarter. If you are a long-term hedger and you're chomping at the bit to be short soybeans, there is another strategy where you can play the short side with a weekly settlement below 1139 and a quarter. You could lift some of those hedges in the 1070s or just hold on and then play the long-term possibility of the 930s as we continue into spring, summer of next year. But of course, you need to maintain a relatively tight stop on the way back up, because if we close back above this formation at the end of any week, that's a bit of a head fake, and the market is then prone to rally significantly over the following weeks ahead. That's it for soybeans. Let's finally finish with crude. I like to talk about crude because of its implications for both ethanol and heating oil, which are significant products for grain farmers and ranchers and so forth and so on, some of the listening audience. Anyway, I'm backtracking here just a bit. And this was a daily chart buy signal, by the way. On this particular week, we pushed through it, but I certainly have a buy signal. It would look a little bit better on the daily chart, I can assure you, because it was a little more, your ability to get in this trade was clear. This one looks as if, well, geez, if I had to wait for the market to settle on Friday at 42 and change, I don't have a chance to buy 39 or wherever this was at the time. But let me just abbreviate this conversation and say that holding above 39 even, this channel top, once we settled above it, did elicit a signal for the upper 40s. 49.35 is the top of this resistance. I'm going to give you the base of the resistance in just a moment, but this remains a target, holding above the upper 30s, still anticipating the upper 40s over the next 2 to 3 weeks. I think is about as long as it should take. And this is a significant area. Not only is this an ascending channel top on the March. Did I put March here? That is not March. Sorry, I don't know why I keep doing that. I'm going to have to correct this on the spot. Bear with me here for about 10 seconds. This is a January contract. My apologies. January contract weekly chart. If we settle above it, we've got bullish continuation. I'll show you that in a moment. But this is a range of resistance that can actually contain buying well into next year, because it lines up with a long-term speed line on the weekly chart. And this is the 2008 high against that recent, I call it the COVID low, the April 20 low. And so it is trend defining. It's at 48.34 this week, which is the start of a range of resistance, as I say, up to 49.35, about a dollar range of resistance, able to contain buying not only through January, but possibly well into next year. From here, we can quite easily fall back into the mid-30s over the following month or two. And who knows, possibly lower as we continue into later 2021. I'm not prepared to say possibly lower unless we were to close, for instance, and this is just, I'm doing this on the fly here. There's no exactitude here. But this is a channel bottom here around 34.96, 34.5. That is our support if the market breaks. That is our support that can absorb selling through Q1, and is also the point to settle below for actually indicating a bearish continuation into spring, summer of next year. But we are nowhere near there right now. I'm just saying that 48.34 is our ceiling that can absorb buying well into next year, and whatever implications that may have for heating oil and ethanol. Ethanol obviously also largely influenced by corn. I'll let you be the judge. But if we were to close any week above this 48.34 to 49.35 region, that indicates significant bullish continuation. I then have a 3 to 5 month target at 66.72, and that would put us into spring essentially, where we could easily top out on a monthly basis, possibly on a 2 to 3 month basis. But overall, I honestly, given the long-term scope of this speed line, closing above 48.34 at the end of any week, I wouldn't be surprised actually to see the 78.32 formation into later 2021. This is dropping weekly and will coincide with the 76.90 area. That'll be in the summer. That'll be, late spring. Yeah, I'm just looking at it right now. It'll be April. I'm backing up even more. Yeah, it'll be March. Sorry. So you can see this is coming down. These are the things I look at. How do the formations coincide with old significant highs and lows? This is the 2018 high. Anyway, that's, I think, about all that needs to be said. Yeah, that covers crude oil. Let me bottom line you here. Still bullish above the upper 30s, still anticipating the upper 40s, 48.34, 49.35, significant ceiling, able to contain buying through Q1, possibly into later next year, and a significant upside pivot point well into next year. That's all I have to say for this week's AgriTalk video. So do yourself a favor. Fill out the free trial form on this website. Take that 2-week test drive. You've nothing to lose and much to gain.